Welcome to another episode of Building Up Your Business, the podcast. My name is Erica. I am your host with Operationally Up. We're here to build and scale your operations for your consumer goods and e-commerce business. Remember, from bombs to order fulfillment, marketing to taxes, learn the stuff from the pros before you step in it. Today, we're joined by another pro. Kevin Berson is here to help guide us through our conversation today. Having spent 18 years at global firms like Technicolor and Arthur Andersen, Kevin is certified as an exit planning advisor, mergers and acquisitions professional, business intermediary, and is a merger and acquisition master intermediary. He founded Kinected in 2014, where they help entrepreneurs sell their businesses for maximum value. He has since successfully closed deals in a variety of industries, including e-commerce, manufacturing, clinical trials, wealth management, and more. Thank you so much for joining us today, Kevin.
Thanks, Erica. I'm excited to talk to you.
Well, and today he's the best possible person to be talking to us about ways to increase value before going to market. And I know this is going to be a great episode because, of course, when you start a business, you have an exit strategy for most people. And we have to talk about what that exit strategy actually is. So let's kick it off. And why don't you tell us what some of the financial exits could be for owners?
Yeah, I mean, the most businesses that go to market actually don't sell. I think it's about 70% of businesses that go to market don't sell. I think a lot of business owners just feel that the process is not going to be that difficult and they're going to get maximum value, and that's just not true. Businesses really need to be prepared properly. They really need, the marketing materials of the business really need to tell the right story. There's certain things to say, there's certain things to not say. Your business needs to be shored up financially, operationally, and legally before you go to market. So we really want to help entrepreneurs through that whole process because there's so much misinformation out there and a lot of uncertainty about how this process actually works. So that's our job, is we come in and we help business owners take the right steps so they can go get maximum value in a process, because if they don't have somebody like me working with them, chances are they're not going to be able to sell the business at all.
So when you're talking about 70% don't actually sell, those 70% just end up continuing to run the business themselves, and
or they just kind of wind down and and eventually liquidate and just have suboptimal outcomes. And we're really hoping to educate sellers to not have that happen.
Well, and it sounds like some of the reasons why people don't sell is, you were talking about valuation. Maybe they have an unrealistic valuation. We've all seen Shark Tank. Or the business is not, as appealing to buyers. It sounds like that might be a real big issue. So if we're talking about valuation, how is a valuation actually calculated?
Yeah.
I mean, I know it's probably a very complex process.
No, it's actually not that complicated. It's actually fairly simple. So most businesses, and we work in the $5 to $50 million deal space. So we're not working on $1 billion deals, and we're not working on deals, under a couple million. So in this sector, deals typically sell on a multiple of earnings. So not the revenue of the business. That's a common misperception. And certainly sometimes if you have like a software business with a lot of recurring revenue, you can sell on a recurring revenue, but 90% of the businesses on average that we work with are going to sell on a multiple of earnings. It's really, buyers are investing based on the earnings that the business generates. So different industries carry different multiples. So, for example, most of the deals that we work on in this 5 to 50 million space, they're going to sell between 4 and 6 times earnings. That's really just a common rule of thumb. And our goal is to push that multiple up as high as possible. And if we have a business that's really well prepared, really a leader in their field, and they can really meaningfully differentiate what they do, than we have gotten 6 to 8 times and above in the past. And that's really what we're hoping to do with every business, is really tell the best possible story, create some competition when we go to market that will drive the valuations up. But just as a rule of thumb, 4 to 6 times the earnings, and we use what's called EBITDA, and it's earnings before interest, taxes, depreciation, and amortization. And then there's also some adjustments. A lot of times family businesses have personal expenses, and I'm not some IRS narc looking to bust them, but if we can justify those expenses, then hey, the buyer's going to give us credit, and they're going to get $4 to $6 for every dollar that they identify and can validate. And there's all kinds of other adjustments that are made too. If the business owner owns their property, we have to figure out if they're paying fair market rent, and then a lot of times there's family members in the business, and a lot of times they're making above market salaries or below market salaries. So we need to do a lot of these adjustments and ultimately come up with an adjusted EBITDA number that we can defend to the buyer, because that will be the most scrutinized element on any deal, is what are the true earnings of the business.
What are the true earnings? So a lot of those times I know that businesses go to market and they are looking at their EBITDA and they're saying, oh, well, I'm just going to take my EBITDA number and multiply it out and there we go. But what I'm hearing is that you really have to go with a fine-tooth comb into what those expenses actually are, because like you said, if people are making above rate and salary,
Yes.
or below rate and salary, or they have other write-offs, those will all come out. All the ghosts in the closet will be
100%.
discovered.
100%. I mean, that's also a common misperception, is that, buyers are going to take your financials at face value. They will absolutely not do that. They are going to scrutinize them. They are going to bring in teams of accountants and tax professionals to scrutinize the numbers. They are going to do, if it's a deal over, call it 10 million, they're going to do what's called a quality of earnings report. They're going to be bringing a third-party transaction services group to help them really validate the numbers themselves, and they're going to come up with their own opinion of what the earnings number is. So we like to do that work ahead of time. We find that it gives us a lot of credit, a lot of credibility when we go to market, and it really, we also get a third-party point of view. We don't want surprises, because surprises have a way of killing deals and eroding credibility.
I can absolutely believe that. And if they find one misconception or trouble or problem or ghost, it's going to make them dig for more.
Sure.
Because they're saying, well, you already did one, so
what else are they hiding from me? What else are they hiding? And then you're going to see what's called a retrade, which is a very terrible term in the M&A profession, where the buyer kind of changes up the offer midstream, and that's sometimes it's warranted. In which case we'll have the discussion, but our job is to make sure that we go through without any retrades and not give the buyers any reason to change their price.
Gotcha. That makes sense. If you're upfront and honest, then there really isn't much to hide, and it should be smooth sailing. Should
Exactly.
be smooth sailing. So then there's a lot of different calculators online that you can use that say, oh, this is a valuation calculator. Are those good for companies to use? Should they?
Those are obviously way overly simplified, and who knows what the data sets they're using to come up with those conclusions on multiples. I think there's so many variables, and we poke pretty deeply in the process. For example, what if 60% of the company's sales are to one client? That's called customer concentration, and buyers are going to reduce their valuation and also change the deal structure based on that. So I doubt there's too many calculators out there that factor that in. Also, what if you don't have a team? What if you don't have a management team that's coming with the deal? And how do they evaluate the team? And all the qualitative factors that go into a business. What's happening in this industry right now? How is AI impacting this business? What are competitors doing? There's so many factors that go in just besides the basic EBITDA number. There's momentum, there's trends. What does the last 3 years look like? What do the next 3 years look like? So you really need a really committed and experienced M&A advisor to help you through this process, or else those calculators are dangerous, right? I mean, you could walk around with a wildly unrealistic expectation, which we find a lot of sellers that rely on those numbers tend to walk away.
Gotcha. Well, and it sounds like from what you're saying, the other aspects, not just the EBITDA, the other aspects of the business, and not to jump the gun and going into the tips or anything, but how your company is running, who your team is, all of that really plays a heavy hand into what that valuation is going to be. So if a seller, for example, is trying to get out of the business because they're stressed out about running their business and it's, they're doing too much of the work, they're going to have a trouble selling it because other buyers are going to see that and not want to buy because of those reasons.
Yeah, I mean, the business really needs to be really very well presented, and you want to basically be able to preempt buyer questions up front. So you really want to give them the full story with the marketing materials, so you don't waste time later, and you get offers that are going to hold up during diligence.
Yeah, got it. So before we kind of go into these tips for success, tell us what some of the pitfalls that these companies fall into actually are.
So a lot of times, businesses that don't sell, they tend to have a few different problems. So one of them is customer concentration. So we talked about that. So, if you're, manufacturer consumer products, and let's say you're in Costco or Walmart, and a lot of times, maybe you do well there, then they give you more and more orders, and then all of a sudden you wake up one day and 50-60% of your sales to Costco. That is a very dangerous place to be. Very dangerous. You may think it's great, but buyers are just going to see risk. So what happens if Costco, they change a buyer, and that buyer, your contact leaves, and we see that all the time. So we strongly recommend that businesses go to market that are diversified, right? You don't have more than 20% of sales to your largest client. That is one of the first things that buyers are going to do. Number two is the team. Who is surviving? Who is going with this deal? A lot of times the sellers are selling the business because they want to go do something else in their life. And a lot of the businesses that we see in this segment, $5 to $50 million deals, sellers are very involved in the business. So who is going to replace what the seller is doing, and how hard is it going to be to replace that person? So these are the things that need to happen years before you go to market to really, can the seller really take a 3-week vacation? That's a test that we use. Can the seller take a 3-week vacation, and can the business continue to run smoothly? If so, then I think that's a business that's in very good shape. Those would be a couple to look at, and there's many more we could discuss as well.
Yeah. Well, and I can imagine that another pitfall, like we've been talking about, is unrealistic expectations of the process, of your valuation, keeping those ghosts in the closet and thinking nobody is going to find them is probably another big pitfall that people go into this process with.
Yeah, and there's just so many misconceptions, and I like to kind of talk about them and write about them. But a lot of times when sellers think about their financials, they're thinking about maybe the best year they ever had. When a lot of times when I talk to a seller, I ask them about their revenue. Oh yeah, and they automatically just go to the best year they ever had. Well, what's the trend? How are you doing right now? The most important number is, what have you done over the last 12 months? That is the most important thing. And then what do the next 12 months look like? Do you have a forecast? How accurately can you predict your forecast? So, and what's the quality of your financials? Are your financials consistent from year to year, from month to month? Do you have a high quality fractional CFO or CPA you're working with that is preparing a monthly packet of your financials? So we can see, how are your margins fluctuating from month to month? And do you understand why there's variances? These are things that sophisticated buyers just dig into immediately and will shred you if you don't have the answers. So the quality of financials is very important. We definitely recommend that sellers have their books prepared by a high quality fractional CFO, and they prepare their books on an accrual basis according to GAAP, generally accepted accounting principles, to get maximum value. That's definitely buyers, most of their businesses are on a GAAP basis, and they want to evaluate their prospective acquisitions on the same way.
Well, and that sounds like a perfect segue into what types of tips you actually give to buyers, because, having your financials together and being sure that you're using GAAP and being on the accrual method sounds like perfect tips for you that you're going to give our listeners as if they're looking to get their company valuated and sell. The other thing I heard is having solid 3 years at least of financials in accrual and GAAP would probably be another thing to look for, because you can't just decide one day, wake up, and you're going to go sell your business. You have to prepare years in advance for this. So give us some of the other tips that you would give our listeners.
Yeah, sure. So number one is absolutely make sure your financials are prepared, reviewed by a fractional CFO that's worked in your industry or a CPA. That's the number one challenge that I see when I meet a new business owner is, they typically underspend on the finance function. Typically the game is to pay as little taxes as possible. So you'll see a lot of write-offs in the business, a lot of personal and family expenses. I'm not judging. This is just kind of what happens. So what we need to do is clearly isolate those expenses from the business and be able to show the business what it would look like without those expenses in it. And then we also need to show very clearly, what the margins look like from period to period and year to year. So financial preparation is key. Number two is what's your growth story? What is in it for the buyer? If you've wrung out every possibility out of this business and there's not a lot of growth left for this buyer, that's going to be a tough sell. So we really want to be able to tell a really good story of how this business fits into the industry, how important it is going forward, try to understand of the buyer's point of view and how this could benefit a buyer. So a lot of what we do is the storytelling around packaging the business. So really think about what's happening in your industry right now. And if you were going to continue in the business for another 5-10 years, what does your playbook look like? Buyers really love that you've taken the time to do that. Number three would be, we talked a little bit about customer concentration, but really some industries it's very challenging. If you're an aerospace parts manufacturer, there's only so many Northrops and Boeings that are out there. So it's very common that you see customer concentration in certain industries. So if that's the case, then what you need to do is really show that, hey, I'm not dealing with one division, but I'm really dealing with 3 divisions and 7 potential buyers. So I have multi-threaded relationships at all these clients. So almost like they're different divisions, almost a different client. So if you can tell that story, that's really, really effective. We're working with a company that does a lot of construction management in the energy space right now. There's customer concentration, but we're really telling the story that, hey, we're working with 3 divisions in each of these companies, and we're relatively protected, right? It's not one contract or one relationship. Another tip would be talk about your business and the nature of your customer relationships. Do you have recurring revenue? What is the nature of that relationship? Do you have contracts? Do you have a maintenance contracts? Buyers want revenue predictability. So the more that you can show that you have clients that are sticky, the better. We had an amazing experience a couple years back with an e-commerce company that delighted their customers, and we just had fantastic data showing that customers buy 3.3 times a year, and we were able to show the relationship between customer acquisition cost and lifetime value, and really show that this company had an amazing machine to acquire and retain customers. So that really helped us get a multiple well over 8 times for that kind of deal. Another tip is management team. What does your team look like going forward? Can let's give an org chart. Here's the key people. Here's why we think they're going to stay. They're motivated. And then we also recommend that sellers give some of those key people retention agreements. So if you need them on the deal, we certainly want to keep the circle of trust as tight as possible, because we really want to respect confidentiality. We don't want anything getting out on the street. We don't want employees to know about it, because these deals are a long roller coaster of emotions. They'll take 6 to 8 months. We don't want customers knowing about it. We don't want employees knowing about it. But if you have a key employee, a CFO, a COO, you will probably need them in the deal process during diligence. So we highly recommend that you create incentive structures to motivate those people to help you close the deal. And then often there's some part of the deal that's going to be paid out over time, and you want to make sure that those employees are heavily motivated to stay on. That's a key tip as well. And I'll just I think those are some good ones for now. I can put a few more, I think.
And, a couple of things that came to mind, number one, when you're talking about key personnel and if the business owner can go and take a 3-week vacation, as a good metric, I would think that fractional executives would be a great option, as far as it's not costing you an expense, not costing the buyer a very heavy salary, but it's allowing them to go and take those vacations, and that there is a leadership team and that these people can stay on. Would you agree?
Yeah, absolutely. I mean, there's really need to make sure that the team is solid and roles are very clear. We also like to see that company, like, key business processes are documented. That's another tip that buyers are really interested in. If you can go to market and you can show that you have a really tight new customer onboarding process, you have a really tight collections process. If you can show that you're really on your game and you have all these processes documented, that's another way that buyers really see a lot of value. So we definitely help our potential clients, prospects, go through that process and bring in.
So that's where having those really seasoned the executives come in that 3 years that you're preparing to sell the business, or even longer, so that you have a lot of these operational processes teased out, and that the seller can take the time off, can do all of these things, so that the business is more attractive when it goes to market.
Yeah, another really important point that we haven't touched upon is the legal side of this. Buyers are going to review all of the agreements that the company has with customer contracts, supplier agreements, employee agreements, NDAs. All of those documents are going to be reviewed very closely, so we recommend, as part of our exit planning process, that we bring in a corporate attorney that specializes in M&A that will review these agreements ahead of time, so we're aware of what transferability of these contracts is going to look like. Because you could have the greatest business in the world, but if it's going to be incredibly difficult to transition your agreements, you're going to have a tough time selling that business. So there's definitely a pretty thorough legal review, and same thing on the HR side as well. We definitely want to make sure that there's no litigation with employees, or employees that might feel like they are owed back pay, or we definitely want to make sure that those reviews are exactly.
Well, and you actually just made me think of a point that we kind of tiptoed around but didn't explicitly say. When you're talking about diversification with customers, I'm assuming that would go the same way with vendors. If you're co-manufacturing products and you don't have contingency plans for when things go wrong, and you don't have diversification of your vendors, that could be another potential risk that a buyer might see.
Yeah, and that's definitely a hot button issue right now, as there's a lot of activities, a lot of companies are trying to find alternatives for manufacturing in China, and trying to reshore. So where is a company at in that process? Do they have alternative suppliers? Yeah, that's 100% right. I mentioned an e-commerce company we worked on. That was an issue. They had single source manufacturing in China, and the buyer asked a lot of questions and did a lot of diligence about that. Ultimately, they were able to get comfortable with that situation, but it certainly would have made the process move more quickly had there been alternative suppliers already in place.
Yeah, and in our podcast and in what I do, we talk about that a lot, because for those of you who listen to the contingency episode that we did recently, That was a big topic that we talked about when you're having your plan for your business resilience plan. The other thing that I was thinking about, we have a fair amount of listeners that do e-commerce businesses.
Yeah.
So when you're talking about customer diversification and those sticky customers, the e-commerce customer that you talked about used as an example of people who are coming back and buying 3 times a year. What kind of tips would you give e-commerce companies? Because I've heard that
Yeah.
e-commerce companies have a higher risk when they're going to market.
Well, yeah. So the key thing with e-commerce that you really need to look at is, where are the sales coming from? Are they coming from your own site, which is the best because you can develop a one-to-one relationship with that customer? And the company we sold had 80% of their sales direct to customers. When you go through Amazon and other channels, TikTok, you don't have that direct customer relationship. So those companies are not going to sell for as much as they would if you had your own relationship, right? Because Amazon is constantly changing their algorithm, they are constantly changing their fee structures up, and you don't have that direct relationship. So if you have that direct relationship, you can do individualized promotions, you can create VIP programs and loyalty programs, and you can do so many things to increase. You can do email marketing, you can do text marketing, you can do all these things that really do move the needle on your business, and buyers really want that direct customer relationship. So we definitely encourage e-commerce companies to invest in their own channels as much as possible.
Well, and I think that's another reason why you would recommend that companies are working with a team that's preparing them to go to market 3+ years before they actually sell, because that's going to take time to develop a community and to develop your sales from your site if you're very heavily relying on Amazon or Walmart or Target.com.
Yeah, for sure, and that's not easy to do, right? It's not. I'm not.
No.
I don't want to oversimplify how tough that is, but it's very important. If you want to get absolute top value, there's nothing better than owning the direct customer relationship.
Which makes sense, but yeah, to your point, there's so many businesses that have gotten used to selling on Amazon. That's not an easy lift to do.
No.
So what types of tools are out there that our customers can use, or what types? You mentioned a few different types of advisors that people would use, but give us some more information on tools that people can be using.
Well, I mean, one thing I want to talk about is we've developed a process called Exit Boost, and this process works with business owners 1 to 3 years ahead of the time that they want to sell. So I think we add a lot of value in this process by giving them education. So if you were to sell today, for example, we give them a valuation today based on objective criteria that buyers are going to use. And we show them, hey, if your margins are not quite in line with the industry norms. So we look at that and we look at what the team is going to look like that's going to be transitioning. And we go through this diagnostic to show, hey, you're likely to sell today at a 3.5 times multiple, which would mean a $4 million valuation. However, if you can get your financials to GAAP basis, which is very, very common thing to do, you can alleviate your customer concentration issue. You can get your gross profit up to industry norms, then we can move you from a 3.5 multiple to a 5.5 multiple. And that extra 2 points could be worth an extra $3 million in your pocket. So that's the kind of work that we're doing. We're also making a lot of recommendations for how to actually move the needle on the valuation. We're making introductions to wonderful consultants like yourself that can really help them on the operational side. Attorneys that can help review the agreements ahead of time. Fractional CFOs that can get the books in line. And yeah, after we do this diagnostic assessment that usually takes us like 3-4 weeks, we get in very deep. We produce like a 30-page kind of document in on average, and we've done them across many different industries. We then have a meeting cadence that will work with the business owner on a periodic basis. Typically quarterly, we find it works really well, and we see how we're progressing against the target objectives. And we are here as a resource, and we're here to be quarterback of the process. And whenever the business owner is ready to go to market, we are ready to move very quickly. Business has already been in the process of being prepared, and we can kind of jump into that full sales process very quickly.
So then, would you recommend that companies are preparing for a sale 3 years ahead? Is that the magic number, or is there a different
Yeah, I
number?
mean, yeah, 3 years might be. 3 years is a great number, but a year we can get a lot done in a year as well. So I'd say generally at least a year.
Okay. And that probably depends on where the company actually is today, because if there's a lot of work to be done, a year is probably not going to be enough. But if they're pretty good to go and they just have a few minor tweaks, then a year is plenty of time.
Yeah, it's really, you really want to make sure that you have the right narrative for the business, and you want to show a very positive trend in the business. So however long it takes for you to do that, if you're already performing well, books are already in good shape, then we might not need a full year. But if you need to, drastically change the way the business is functioning, and change your business model and move to a more recurring model, and have some very difficult conversations with customers and renegotiate some agreements, that's going to take some time.
That's going to take time.
That's going to take a couple years.
So then, if you've given a lot of tips about how to be successfully prepared and have successful processes and get the most out of the valuation, for those companies that maybe don't have all of this together, and maybe they look at it and they go, that's just way too much work, is there hope for them to sell, or are sellers just going to give them bottom dollar for it, or are they not going to sell at all?
I mean, it really depends on the situation. I mean, there's a buyer for every business, but it really just comes down to expectations and what is the seller hoping to achieve. We really believe in getting sellers a good outcome, and good is different for everybody. A lot of sellers, some sellers, money isn't, believe it or not, money isn't always the ultimate driver. Sometimes it's getting the best deal for the employees who are going to stick around, and finding them a comparable culture that they could go into. Money's always important, but some sellers it's not the most important thing. You want to make sure, a lot of sellers are very concerned about their legacy, and they want to make sure they do right by their employees and their customers. A lot of these business owners have had their businesses for decades, and the businesses are children, feel like children to them, and they really want to make sure that the legacy is protected. So, they don't always sell to the absolute highest bidder if the bidder doesn't have an aligned culture. So that's very important too. Is you want to definitely make sure that you have enough interest in the business that we get to pick the right buyer, that we have a kinship with, that we really trust and really feels right. And it may not always be the buyer that's willing to pay absolute top dollar.
That makes sense. It's all about knowing yourself and knowing what you want out of a deal before you go into it, which I think is, as business owners, we all know that you need to make sure that you know what you want out of things before you start down that road.
Yeah, and that's another point I really want to hit on. And this is probably the least discussed aspect of mergers and acquisitions, is the deal psychology, right? So seller, we want to make sure that our sellers, part of our exit boost process is preparing the business, but there's also a huge amount of work to prepare the seller's emotional state to sell. What are their reasons for selling? What are they going to do after the sale? Is this business going to be able to fund their lifestyle after they sell it? How do you replace all that income? So there's a lot of really difficult questions that we need to ask, and going through the SEPA methodology kind of really helped frame this for me, where you have you bring in a team, you have the wealth manager as well, you have the attorney, you have the CPA, and then the M&A advisor. We work collaboratively to really help the seller through this process. And they really need to have a very good idea of what their life looks like on the other side. And if they just feel like they're burned out and they're running away from their business, that's not really a good reason to sell. They really need to be excited about their next chapter and really have a very good idea of what that looks like, or we're not going to have a good process. I've seen it happen many times where sellers just really weren't ready to sell, they weren't in the right state, and then when they sell the business, they may regret it, they may get health problems. I've seen that happen quite a bit, where Yeah, where sellers just, this is their identity. For so many business owners, these businesses are their identity, and they get their purpose, and they're a pillar of the community, and there's so much emotional investment in these businesses that it would be a mistake to sell until they're actually ready. So this exit boost process kind of gives them the breathing room to really start thinking about what this is going to look like for them. So I can't talk enough about the psychological importance of this process as well.
When I heard the percentage of sellers who have regret post-transaction is actually really high.
It's high, yeah, because they don't go through this soul searching process. The businesses may not be prepared. They go in, they don't have the right information. They think they're going to get 3 times revenue, which is almost, unless you have a software subscription based business, you're not going to get that, chances are. So they walk in with bad, improper expectations. They don't get what they are hoping to get. They are upset, and now they lost their baby. So, yeah. So this is a very emotional journey. Our deal processes typically take 6 to 8 months, and then there's typically a post sale transition process where buyers typically want maybe 6 to 12 to possibly 18 months for the sellers to stick around and help them with the transition. And then if you're talking about starting to prepare 1 to 3 years ahead of time, this could be a 5-year process.
Yeah. Well, and you mentioned getting health problems. If they're stuck at home post-transaction with nothing to do, staring at the walls, their spouse is like, please get the heck out and go do something. And you can only golf or go to the tennis courts or go to your hobby class so many times in a week. The gym, you can't go every minute of every day.
That's exactly right. I say that all the time. You really have to have something else that you want to go do that's going to consume your time. So we really want to have our sellers really think through that plan. It's really, really critical that they do, or else, like you said, there are going to be some seller's remorse.
Yeah. This has been such a wealth of knowledge, Kevin. Thank you so much for joining us today and sharing all these tips with our listeners. I know people will appreciate it, so thank you so much for being with us.
Thank you, Erica. You asked really great questions, and I really enjoyed the discussion. I really, really appreciate what you do.
Awesome. Oh, thank you so much. Well, remember, from bombs to order fulfillment, marketing to taxes, learn the stuff from the pros before you step in it. My name is Erica Dill. I'm with Operationally Up, your host every 2 weeks for these great episodes teaching you all the things you need to learn from the pros. We will be back in another 2 weeks with another entertaining episode, so we hope that you join us then. Until, have a great day and a great week, and we'll talk to you soon. Bye.